Um, Welcome to the New America Foundation. We're very pleased to have you here this afternoon for an event featuring Gary Rivlin and his new book, Broke USA, From Pawn Shops to Poverty, Inc., How the Working Poor Became Big Business. And I'm Reed Kramer. I direct our asset building program here at the New America Foundation, and we focus on the policies, programs, and practice that aim to get people moving towards social development and economic opportunity, and are especially focused on ways to get families to save and build up assets over time. And in this work, we have a long-standing concern about the dynamics of the savings process and also the impediments that many families face that have to be overcome to build up these resources and then deploy them productively. So being able to save and just manage money is a fundamental component of charting a path towards economic security. And I think we can recognize that this is a need that extends up and down the income scale, but it's particularly important for families with lower incomes and fewer resources. And yet, when we look out at the financial services landscape, it's littered with obstacles to this process. Basic bank accounts that have transparent fees and low costs are difficult for many families to access. And then in their place is a variety of products that can be quite debilitating. Payday loans, instant tax refunds, high-cost check cashers. There's a whole array of these products and services that are out there that are high cost and low quality. And worse yet, they're poorly understood by both people taking out these products at times and also the policymakers who have kind of stood by and watched this sector grow. And that's really one of the most interesting things about it is that it's grown tremendously in recent years. And whether we call this the alternative financial sector, the fringe financial sector, the non-bank sector, there's a whole array of products and services that just are not governed by the same kind of federal oversight in recent years. So it's really, in fact, something that's become big business, and it's one of the reasons why we're really pleased to have Gary here with us to talk about his book, because until recently, a lot of this sector was unexamined. And I think that this book fills the void in some important ways, really making it a really relevant contribution. So it is relevant. It captures the story of multiple perspectives in the growth of this fringe sector. The families, the purveyors of these products, some of the would-be moguls that are out there, and also the advocates. And whether or not these are legitimate businesses that are providing a necessary and needed service, or there are kind of scams and gimmicks that need to be shut down with greater oversight, I think we can all recognize that, and we need to acknowledge that this is how people are accessing financial services and products in their communities, and this is how they're managing their money. Another feature of the book that I'm pleased about is how obviously timely it is. And just last week, the Congress passed the Dodd-Frank financial reform bill. It hasn't even been signed at the president's desk yet. It's due any day now. And it really has the potential to really change the landscape significantly, change the marketplace, and creating for the first time this consumer watchdog agency that will have as a mandate oversight of this sector and making sure that all financial services and products are transparent and fair and simple, regardless of whether they're given and provided by banks or other financial service providers. And the third feature of this book that I'm pleased about is really how instructive it is. When it tells its story, it raises a lot of really important points that I think the regulators are going to have to keep in mind. In fact, the staff of this new bureau are really going to have to read this book. Should help sales when they come online. But it's a very important story, I think, for regulators to keep in mind. Making sure that people aren't necessarily, even though if they might need certain products and services, they aren't held hostage to them to the terms and conditions of them when they can be quite financially debilitating. So, with this book, Gary really delivers something that's insightful, and it has a very engaging presentation that I hope he replicates today for us all. But it also serves up a number of contemporary policy issues that I think that we're pleased to have him here kind of in the think tank environment to discuss more today. I think we'll hear from Gary. His bio is available in the handouts in front of you on the web for our viewers. He's written for a number of publications, New York Times, Wired, Newsweek, among others. And written a number of books as well. In fact, I actually just realized this morning that I read your first book on Harold Washington in Chicago. That was written a few years ago, but I'm not sure I could summarize it right now. But I was actually surprised to see that, but remember reading it at the time. So anyway, we're going to hear from Gary. You can purchase books from our friends at Politics and Prose afterwards. And after Gary speaks for a few minutes, my colleague Alejandra Lopez-Fernandini is going to talk and offer some commentary. She's a senior program policy analyst here at New America Foundation and the Asset Building Program, and a lot of her work focuses on kind of household financial management issues. She's written on the need for unrestricted and flexible savings that many families have, and she leads up our efforts on this pilot project called AutoSave, which is examining new pathways to savings in the workplace through payroll mechanisms. So after she gives some commentary, I'll pop back up and moderate the discussion, and we'll hear from you, get some of your questions, get Gary to respond, and that's the drill. So without further ado, Gary.
Thank you for that nice introduction, Reed. So this wasn't my only invitation for today. The pawnbrokers are holding their annual convention right now in Las Vegas, and they had asked me to come out. It probably says a lot about my life in the last couple of years that I was really tempted. It's 110 degrees or so in Las Vegas, but the idea of spending a couple of days with pawnbrokers seemed really inviting. But I had actually applied for a fellowship from New America back in 2001, and in response, I'd gotten a very polite form letter. And so when Reed invited me today, I felt like I really couldn't say no. I'd been waiting 9 years. So Reed, thank you very much for addressing your note, Dear Gary, rather than to whom it may concern. Thank you, New America, for putting on this event, and thank you all for coming. So let me see if I can tell the history of the poverty business in about 3 minutes. It's not new. We've had pawnbrokers for centuries. The check cashers started operating in the big American cities in the 1930s. Rent-to-own, that odd business of people renting their furniture by the week, and eventually many hundreds of dollars later owning it. That started in the late 1960s. What changed is that it became big business, and I mean eye-popping, Wall Street's paying attention, holy moly, big business. Used to be that the pawnbrokers were dominated by mom-and-pop shops. Now there's also Cash America, which is a chain of 650 pawn shops, and they brought in about $1 billion in revenues last year. There's 6 publicly traded check cashing companies, or 7 if you include Walmart, which a few years back got into the check cashing business. It used to be you can buy a Cadillac, buy the Mrs. Mink stole kind of rich, and now it's tens of millions, hundreds of millions of dollars. Some of the entrepreneurs, some of the more successful entrepreneurs have been able to do rent-to-own. It's 2 publicly traded companies dominate the rent-to-own business, and collectively they bring in between $4 and $5 billion in revenues a year. But it's more than just some old line companies going Wall Street. There's been an incredible amount of innovation by entrepreneurs and big companies, seeing the money to be made off the working poor. At the start of the 1980s, we saw the introduction of the subprime mortgage. In the late 1980s, it was the subprime credit card and also the refund anticipation loan. Those are those instant tax refunds. The payday loan was introduced in the early 1990s, and maybe the most incredible thing about the payday loan, those are cash advances against your next paycheck, is that 13 years later, by 2006, there were more payday loan stores in this country than McDonald's and Burger King's combined. They're making loans of $300, $400, $500 at a time, and yet last year they made more than $40 billion worth of these loans and collected $7 billion of fees, or alternatively saw the drainage from people making $20,000, $30,000 a year of a collective $7 billion. And so in the book, I try to chronicle the rise of the poverty business, and I tell the story through a range of emblematic characters, many of whom might be called the pioneers of subprime. And in a nutshell, the book is lots of entrepreneurs and businesses saw the huge amount of money to be made on the economic fringes. Some people got hurt. Consumer advocates got involved. They won a lot of victories, but they're up against a foe with a lot of money and ultimately lost. Alan Greenspan saw that there was a problem with subprime mortgages and spoke out against the problem of the most vulnerable, to use his term, were being targeted by these subprime lenders. It just philosophically, he didn't believe in doing anything about it. Over at the Office of the Control of the Currency, you had John Hawke doing everything in his power to make sure that the attorneys general around the country that wanted to do something about subprime abuses couldn't do anything. He, for me, stands as one of the goats of the subprime debacle that isn't really getting his due in terms of blame. Probably the most unfortunate subprime loan ever given out was to Phil Graham's mother. Phil Graham used the story of his mom getting a subprime loan, I think it was in the 1950s, as his excuse for fending off every attempt at reforms that might have, if not avoided the subprime collapse, mitigated the problem. I might want to point out to Mr. Graham that when his mom got her loan, there were caps in place on the interest rates you could charge for a mortgage. I might want to point out that you couldn't charge more than 1% in upfront fees. All that's changed, but it probably would have made a difference. He took so many hundreds of thousands from mortgage lenders that I don't think it was really going to change anyone's opinion. And let's just say that Chris Dodd and Barney Frank didn't do that much about financial reform until the last year or so. So this was a really, really, really fun book to report. I might not have been able to go to the pawnbrokers convention this year, but I did go to the 20th annual check cashers convention in Las Vegas a couple of years back, and I sat in on these various workshops. Probably my favorite was a 90-minute session on how to turn the customer you were getting $1,000 in revenue per year to one in which you got $3,000 in revenues. Of course, keep in mind that these are customers typically making $20,000, $25,000 a year. You have loyalty programs like the airlines have. You have raffle off things like iPods. You give away free check cashing. Cash 3 checks, you get the 4th one free because, as the fellow running the session said, these are people not used to getting anything for free in their lives. A second session I sat in on was about making your businesses politically more palatable. And his argument, the fellow who ran this workshop, his argument was that let people pay their parking tickets at your check cashing shop, at your payday loan shop, at your pawn shop. Let them buy their commuter passes. Let them do anything that gets you engaged with government because, first off, that will bring more people into your store, and that's always a good thing. But more importantly, if you come under attack, you suddenly have a really, really good friend in your partner, the local city agency, the local county, and all. I also spent time with Tim Thomas of Daddy's Money Pawn, love that name, in Wichita, Kansas. And, you know, I talked to a lot of entrepreneurs in the poverty industry, and what made Mr. Thomas different than most was his candor. Most of whom I spoke with talked about the nobility of what they did, but he was pretty blunt. He's making a good living, and he was really happy that he had these various kickbacks and other ways to make money. So, of course, he was in the pawn business, but he'd also gotten into the check cashing business and would charge up to 10% of the face value of a check to cash it. He was making payday loans. He also got in the debit card business. There are some debit cards that have no fees, but the ones you're going to get at a check cashing place have big fees. You're going to pay money to initiate the card. You're going to pay a monthly fee, and some of them even charge for every time you put money on the card or every time you spend. And Mr. Thomas talked again about the kickback he got, in his case from American Express, for the card he was selling. But the best time of the year, no question about it, best time of the year was tax time. He would do people's taxes and get paid for that. He would offer them these instant tax refunds, and he'd get extra money for doing that. He'd pay them in a check, and then he would charge them to cash the check. But the best part is that he had all these people with their pockets full of their return in his pawn shop, buying that many more items. So I was really honored to tell the story of some of the would-be heroes, maybe is the best way to put it, of the subprime battle. Jim McCarthy and Dean Lovelace in Dayton, Ohio, Bill Faith in Columbus, Ohio. One of the great names of this fight, Bill Brennan down in Atlanta legal aid attorney. I feel like Michael Lewis in his book, excellent book, wrote about those who saw the subprime disaster coming in the mid-2000s and got really, really rich off of it. I think about people like Bill Brennan, who saw the subprime disaster coming as far back as 1991, and they didn't grow rich off it. They just grew really frustrated that no one would listen, or at least no one in power would listen. I also profile Martin Eakes. Some of you in this room, I'm sure, know Martin, the founder of the Center for Responsible Lending, and a man whose career shows that you can make loans to those of modest means, make home loans to those of modest means, and still do it responsibly and still do it without losing money. He was a really interesting character. I went down to Durham, North Carolina, where he is. You could kind of sum him up by his car. At the time, it was a 16-year-old Chevy Corsica that for years had a cracked window, and here he's running this agency that was overseeing billions of dollars in loans. He likes to say that half the people he knows would take a bullet for him, and the other half would pull the trigger. And I did spend a lot of time with the payday lenders and others, and I could confirm that there's a lot of truth to that statement. But I will confess that it was much more interesting to me personally to hang out with my subprime pioneers. I went down to Cleveland, Tennessee, where Alan Jones lives. Alan Jones is the one who invented the modern-day payday industry back in 1993, and we became good old friends for a couple of days. He brought me to a wrestling match, and I met some of his friends, and he showed me where he grew up, the home where he grew up, and he showed me his new home, which is modeled on the Biltmore, which George Vanderbilt built for himself. It has 2 elevators. It has a regulation-sized football field and stands with a field house. He's got stables. He's got this huge garage where he keeps his Rolls Royce, his Bentley, his Maybach, which I'd never heard of, but it's a $300,000 car, and a host of other objects like that. He shared with me his views on race. Cleveland, Tennessee, he told me, has just enough black people where the football team can win some games, and they win some basketball games, but not so many that he felt obliged to lock the car at night. So spending time with Mr. Jones meant hearing a lot about the benefits of the payday loans, but it also meant, which I expected, but it also meant a lot of belly aching about critics like Martin Eakes, and also how much it's hurt him financially, those who don't understand the beauty and wisdom of the payday loan. He brought in about $23 million in post-tax profits last year. I mean, that's money that went to him. I tried to engage him in what's enough? And instead, he just felt sorry for himself that he had lost, or the payday industry had lost a couple of battles in Ohio, in Oregon, in Arizona. And by his calculation, that was going to cost him $1 million or $2 million. So why was I bringing up too much when he was losing all this money? I also met with Billy Webster. Webster was he was an aide to Bill Clinton, who founded Advance America, which with 2,500 payday stores is the largest payday lending chain in the country. And I enjoyed Billy Webster. We're the same age, and he's obviously a political guy, just a really interesting guy. And so question I really want to know is, Billy, when you tell people what you do people ever mind? Do people ever react negatively? And he told me well, yeah, it happens at dinner parties and various social events, but you give me a half hour, Webster told me, and I'll convince them for why the payday loan is a good idea. And I thought, I don't know if you're convincing anyone. They're probably just crying uncle after 30 minutes. But this is a think tank, and I don't know if I'm supposed to tell stories and anecdotes of the people I met. I guess it's root causes and unintended consequences and possible policy prescriptions and all that good stuff, which is in the book. I probably don't word it quite the way policy prescriptions usually are. But let me just quickly go over some of the main arguments and turn over to Alejandra and to all of you. Deregulation played a huge role in what I'm talking about. In 1980, Congress took away the states' rights to regulate mortgages. Most states had a cap in place, stopping lenders from charging more than typically 8, 10, 12%. The U.S. Congress preempted that right. A couple of years later, they went further and took away, or they further deregulated the industry by allowing for adjustable rate mortgages, for balloon payment mortgages. Gone was the 1% cap on upfront fees, and that really just opened the floodgates for the subprime mortgage lenders that began in the inner cities and rural areas that had fallen on hard times and eventually opened up in more upper middle class markets. In 1978, the U.S. Supreme Court decided that where you as a customer made no difference if you held a credit card in your pocket, what mattered is where the credit card issuer had its headquarters. So if you've ever wondered why you write your checks and send your money to typically South Dakota, Nevada, Delaware, well, those are 3 states that don't have a usury cap, and so therefore I live in New York. The usury cap there I think is 16%, but still a credit card company could charge me 24 or 30% more despite that usury cap. And also the payday lenders. They like to talk about free enterprise, but I want to counter it by saying, well, most states have a usury cap, and the way the payday industry took off is they put a lot of money into lobbyists, a lot of money into campaign contributions to get exemptions from existing usury laws. Their argument was, well, these are short-term loans of 2 weeks, annual percentage rates really don't count, and they were persuasive in about 2/3 the states. Geography plays a big role here. You've got banks have fled so many working class communities, if they were ever there in the first place, creating the opportunity for the check cashers, for the payday lenders, for these other fringe financiers to do business. And one of the huge surprises for me, at least, in this project was how much, or that the banks hadn't really fled these communities. They closed down their brand name branches, Nations Bank, City Financial, long list, Wells Fargo. They closed down their brand name branches in these communities and opened up off-brand subprime lenders. So they were still in those communities. They just weren't offering you the conventional rate loans, even to people in that community that had good credit ratings and such. Broader economic issues plays another huge role. Last couple of decades, the bottom 40% have seen stagnating wages, while, of course, price of housing, healthcare, heating oil, a range of other costs have gone up, and it gets harder and harder for people making $20,000, $30,000, $40,000 a year make ends meet, which of course drives up the demand for these products. Capital investment, money. It's remarkable the number of banks you've heard of that help fund the various industries I write about. Payday lending, Wells Fargo, Wachovia, Bank of America, those are among the companies that funded the rise of payday lending. They could not have gotten as big as they did, as quickly as they did, without these big brand name banks. Morgan Stanley, they took Advance America, Billy Webster's company, public. Goldman Sachs, they provided tens of millions of dollars in funding to CompuCredit, probably the most infamous of the subprime credit card companies. A few years back, they had to pay a $114 million fine for false marketing, etc. The instant tax refund business, H&R Block, they're the ones who started this business, and it's HSBC, the giant London-based financier, and also J.P. Morgan Chase, that are the two biggest players in the instant tax refund business. There's been a lot of attention on how the big Wall Street banks bought up subprime mortgages that others wrote. But what hasn't gotten nearly as much attention is how much these big brand name banks were initiating, were writing these subprime loans. By the mid-2000s, HSBC, Wells Fargo, and Citigroup were among the top 10 subprime mortgage lenders in the United States. Go down to the top 20, and you've got Washington Mutual and also J.P. Morgan Chase. So one thing that was really interesting was to be exploring the roots of subprime, to be writing about the poverty industries while the subprime mortgage disaster was playing out. And it was not only interesting, it was infuriating. Because what I feel I was hearing was all these people who bought $600,000 houses on salaries good enough for half that amount, or all these people using their homes as ATMs. And that was a big part of the story, but there's also a really predatory side. You know, home repair people knocking on the doors of little old ladies, driving them, you know, like out of the Tin Man movie, driving them to the local mortgage broker, putting them in loans with 20%, 25% annual interest rates, hitting them with upfront fees of 15, 20%. And this was going on all around the country. I learned a few new terms. Packing. That's adding all these extra fees to a subprime loan that people who get conventional loans, they don't even try. Flipping. That's the idea that they give you the loan today, you start to have trouble paying, so 6 months later, a year later, they'll happily refund it and get lots more in upfront fees. I wrote about a couple in Columbus, Ohio, a blind couple in Columbus, Ohio, that over a 3-year period were refinanced 4 times, and they paid $20,000 in fees on a home worth $36,000. There's a huge race element to this story, too, that's been largely underreported. HUD did a study where they said if you live in a predominantly black neighborhood, you are 5 times more likely to get a subprime loan than if you lived in a white one. And even African Americans making over $100,000 a year were twice as likely to get a subprime loan as whites of moderate income. And you know, I'll confess that I was impressed by the cleverness of some of the entrepreneurs here, but there's also a really destructive element. I look at the tax mills, those offering these instant tax loans. So there's a policy, the Earned Income Tax Credit. I'm sure most of you, DC policy people, know this. This dates back to the Nixon era, and it's kind of anti-poverty program that even a lot of conservatives like. And some guy, I talked to him, came up with this idea like, so we've got people making $20,000 or $30,000 a year, and they have kids. They're getting a tax refund equal to about 2 or 3 months worth of their salary. They're going to be desperate for that money. They don't want to wait the 3 weeks or whatever for the IRS to send it back. So let me offer them an instant tax refund. You could get it today or tomorrow. And they started deliberately opening up tax prep stores in neighborhoods where there was a median family income of $30,000 or less. And believe it or not, this turned into a $4 billion a year business that lasts about 4 weeks, by the way. And Earned Income Tax Credit is about a $40 billion, $43 billion a year program. So you see almost 10% of the money just leaking away. So I know we're going to talk about reform, and Alejandra will talk about what's gone on with Congress and the bill the president is about to sign. But I thought it'd be instructive to close with the fight against payday lending in Ohio. For about, a year and a half, the state of Ohio debated payday lending. It was one of the top markets for the payday lending industry, so it was a really important fight on both sides. The activists who hated the payday lending and the industry that saw potentially one of their markets going away. And, the Ohio House had several hearings on this. The Attorney General had hearings around the state on the issue. Debate went on for months. The payday lenders had their chance to give their argument. And in the end, the legislators decided by about a 3-to-1 margin to cap the rates that the payday lenders could charge. Instead of the $15 per 100 they were charging for a payday loan, which works out to an annual percentage rate of 400%, they said, we're going to make you abide by the local usury laws of Ohio, and you can't charge more than 28%. The day after the Governor Ted Strickland, signed that bill, they put on a ballot referendum asking the people of Ohio to reverse what had just happened the day before. And they spent, I think it's like 24 million, I forget the exact amount, but a lot of money. They put on ads about how this was going to kill jobs, and they put forward their argument. And November 2008, the presidential election, Ohio voters also voted on this referendum. It was about 2-to-1 that they voted to keep the 28% cap in place. And what you saw happening is that the payday lenders said, okay, we're no longer payday lenders. We're now small loan lenders, or we're now mortgage lenders. And for the same loan of $200, $300, $400, they now charge a $15 application fee, and they charge a $10 credit fee. And the more ambitious among them gave you the money instead of in cash. They gave it to you by check, and then, of course, charge you a fee to cash the check. And so choose your favorite metaphor. Is this whack-a-mole? You hit them here and they pop up there. Is this, like mosquitoes adapting to a new bug spray? Whatever it is, I just want to point out there's a lot of money at stake. These are multi-billion-dollar industries, and they're a really formidable foe. So.
Thank you, Gary. It's great to have you here. Thank you, everyone, for joining us. I'm going to start by making a few observations about the book, and then pivot to some policy-related issues with an eye towards solutions. I found Broke USA to be an important complement to the jargon-heavy coverage about the collapse of the housing market, the economy, and its impact on the poor. Its detailed profiles and plot lines weave through the past few decades, highlighting the interconnectedness of what Gary calls Poverty, Inc., with the mainstream financial sector. And through well-told stories, he brings out the culpability of the big banks much of middle-class and upper-class America depend on for their everyday financial service needs. Broke USA effortlessly explains those hard to understand and often hard to believe financial practices like yield spread premiums or equity line conversions. If you were looking for examples of how lenders rarely align their interests with their consumers or any number of other egregious business practices, there is no shortage of them in Broke USA. As Reed said, the book is very timely, arriving for wonks and wonkettes just when the consumer protection pieces are falling into place and financial regulation is imminent. But before launching into policy, I want to make 3 points about the payday loan structure, the profile of loan borrowers, and one of the book's protagonists. With respect to loan structure, it's really necessary to emphasize the importance of loan duration, which is in most cases 2 weeks. According to analysis of the payday lending industry usage activity in 2 states, the Center for Responsible Lending observed that 76% of loan volume was generated by a new loan taken out within 2 weeks of repaying the previous loan, which is a pattern known as churning. If the purpose of the payday loan was, as the industry claims, for emergencies only, why do 3/4 of every dollar of revenue come from back-to-back loans to the same customers? According to the same study, only 2% of loan volume is driven by non-repeat customers. Again, this really drives home the importance of the loan terms and how they're really derived to benefit the lender. Second, there are many different faces to the payday loan, check cashing, or underbanked consumer. Though many are working poor, income is not the best descriptor. In other words, it's not just single moms making $22,000 who are poverty industry's prey. The typical payday loan customer holds a checking account from which he or she can post-date a check, is steadily employed, likely has impaired credit, and earns less than $50,000 a year. That represents a pretty sizable and broad share of the entire population. And while I think one of the book's strengths is that it draws in multiple perspectives, I found Broke USA gives a little too much ink to critics who try to blast self-help in their policy affiliate, Center for Responsible Lending. This feels perhaps like an overreach on Gary's part, trying to balance the poverty industry's party line with that of the consumer advocates. I found the characterization of Martin Eakes, through perhaps the author's eyes and through repeated mentions of industry rants, only to illuminate really how contentious this debate truly is. In full disclosure, I interned at Self-Help during graduate school. So building on that solid narrative, I want to turn now to some policy issues. By the book's end, one could be forgiven for thinking that rampant financial illiteracy combined with enterprising, free, and morally questionable market actors ought to shoulder the blame for credit gone wild. But that's not entirely accurate. According to the FDIC's Household Survey of the Underbanked, the main reason payday loan customers select this product is their perception that it's easier to acquire than a bank loan. So if that's a sense of the demand, what does the supply look like? In the FDIC's companion survey of banks' efforts to serve the underbanked, only 43% of banks reported offering small dollar loans, but unfortunately this number includes overdrafts as loans. So this skews the data and probably inflates the actual number of banks that are supplying small dollar credit. The Poverty Industry Establishment, or the Poverty Inc. establishment, has big banks to thank for turning their backs on their customers. And second, throwing the coal in the furnace to fuel the alternative financial industry's ability to serve these customers in unproductive ways. However, the overarching problem, at least raised by the boon of pricey financial services and products, is that too many people lack a secure financial safety net, whether that is an accessible savings account to meet urgent liquidity needs or safe credit to buy an asset. Given this dynamic, it is important to not close off access to fairly priced credit. It is equally important to support strategies to repair blemished credit and to create opportunities to establish credit history for the very first time. Credit is essential for any family to get ahead and achieve upward financial mobility. It was too easy to get bad credit, and now it's too hard to find good credit. This is where savings comes in. So let's do the math. If the average payday loan is about $325, it's not an impossibly big sum to reach, especially if one saves $50 each month for 6 months. Given the right structures and supports, can having savings mitigate the need to borrow cash at high costs? Or is it going to take more extreme behavior measures to do so, like forced savings? The AutoSafe pilot, which is co-managed by New America and MDRC, is testing this very proposition by delivering a simple savings account, one that meets people where they are at the workplace and builds savings through regular deposits. We're working in a mix of public and private workplaces and encouraging employees to open a low or no fee savings account and authorize their employer to directly deposit $15 to $25 from their take-home pay into the account. So far, the results from 4 to 6 months of piloting are very promising. Between 10 and 25% of employees are participating. We think that's pretty respectable for an opt-in savings plan with no precedent, no financial match, and in this economic savings climate. Emergency savings is but one piece of the financial landscape, the others being assets, long-term savings, insurance, and to overlook any one piece ignores the financial reality of the folks we're trying to keep in mind right now. One way to address this is to integrate credit with savings, using loan repayment to also encourage regular savings. But non-depositories, such as payday lenders, where folks are doing their small dollar borrowing, do not accept deposits. This is an example of a conundrum or a regulatory challenge that needs to be addressed. This also creates a space for innovation, perhaps a space for prepaid cards or debit cards to really push the envelope and start innovating with savings. Marrying these two functions, debt repayment with regular savings deposits, could pave the way for not only a new small dollar loan structure to replace abusive payday lending, but promote a solid form of self-insurance. The FDIC recently wrapped up a 2-year small dollar lending pilot that demonstrated that borrowers are more successful in repaying their loans when they have more time to recover from the financial emergency that necessitated the loan. So in contrast to the 14-day turnaround time that payday lenders require, these pilot banks offered no less than 90 days and engaged in simple but responsible underwriting. The FDIC pilot was certainly a step in the right direction, but there remain issues of scale, appropriateness, and cost-effectiveness to be worked out. Lastly, the Poverty Incorporated discussion implies that people are getting rich off the uninformed. To the very cynical reader, this leaves room to suggest financial illiteracy played a big part. But the book also makes clear that people are getting rich off persuasive sales tactics, aggressive behavior, and information asymmetries. This has implications for promoting financial capability. In-class financial education is not enough. We need to make sure what is taught is relevant and helps consumers make good decisions at the time they are required to make them. The FDIC small dollar loan pilot observed lower charge-off rates among sites that offered financial education compared to those sites that did not. Just food for thought. Broke USA highlights our country at a time when our consumer protection system is broken. My reading is that Poverty Incorporated chased profits and broke our trust. Given the policy changes taking place now, it would be very interesting to revisit this topic, and we invite you back for this conversation, Gary, a few years from now. Thank you.
Great. There's plenty there to follow up on. Actually, do you have some comments on that, some of her points, especially that last one? I think you were talking about some of the practices of the selling that you found particularly relevant.
Is this on? It's interesting. I had actually started off this project thinking a payday loan was a pretty good idea. Like, you don't got a rich uncle, you don't have a credit card, your car breaks down, you need a quick $300. And Obviously a lot of it is what just Alejandra just spoke about. The person who's so desperate today for $300 that they'll pay the equivalent of a 400% loan, how are they going to have that extra money to pay it back? So there's something inherently wrong with the 2-week loan. But another aspect was the aggressiveness with which they sold these products. They created the demand. They just didn't meet a demand. The big chains, you hadn't been in 30 or 60 days, they'd call you. Well, it's an emergency loan. What are you calling about emergencies for? They would upsell you. You come in and, oh, look, Alejandra, you're only asking for $200, but you qualify for $500. And they were instructed at this one chain, Check and Go, to ask 3 times, or mention 3 times, you could borrow $500. An emergency loan, these are dangerous financial products. They're very, very expensive. People get into traps. They're offering the first loan for free. They give out cards. Every chain has this. They have little cards there. Bring in a friend, bring in a family member, bring in a coworker, and we'll give you $20 off your next loan. We'll give you $20 free in gas. So some of it was just the methodology. And there's one other point I'd like to mention that Alejandra brought up, and that's if someone has a $500 savings account, there is no pawn business. Pawnbrokers, the average size of a loan is $90. The average size of a payday loan, as Alejandro just said, is $325. So if people just had $500, and we have the earned income tax credit once a year, a lot of folks are getting refunds of $2,000, $3,000. Just put $500 aside, and you'll have this cushion, and you'll never have to pay these kind of exorbitant fees. A pawnbroker, by the way, is much cheaper than a payday lender, but depending on the state, they still charge on their loans 60% annual percentage rate to 300% annual percentage rate. So the pawnbrokers are also a very expensive alternative.
Yeah, and of course that's one of the reasons why we spend so much time and energy around here focusing on the savings process, just getting it started, even at very low levels. It can make a difference in people's economic security. I actually read your book and Michael Lewis's The Big Short back-to-back, and it was actually a very instructive pair. Certainly encourage everyone to read yours first. But together they really make the case for re-regulation of the sector and show how the Main Street and the Wall Street are fundamentally connected, and they were really part of the same phenomenon. So, okay, now here we are at this moment. We're going to re-regulate this sector, but we actually don't know what comes next. And I guess that's part of what I think we're going to try to do here in New America and at Washington over the coming months is to figure out what that looks like. But I kind of wanted to ask you, given your reporting and observation about what is it about some of these practices that you'd like to see retained, and what would you like to see outlawed? I mean, you've just mentioned some of the practices, but how and I think it raises the question of how are we going to set some standards for this new regulator that has potentially a lot of power, and yet a strong mandate, but with some unclear direction about what to do next.
Well, first, there's a lot of limits to what even an aggressive Consumer Financial Protection Bureau can do. The Obama administration specifically asked that this new agency not be given the right to create a national usury cap that angered some consumer advocates, but I thought it made sense. I mean, we're going to have as significant a policy change as a national cap on interest rates. I really want Congress and a president to decide that. I mean, sure, there's a much easier way if we could have Elizabeth Warren do it really quickly with a snap of a finger. But so, a lot of what we're talking about is capping the rates, and that's not something that this agency is going to be able to do. I also think there's been some really creative alternatives. Kay Hagan from North Carolina, probably not a coincidence that she represents Martin Eakes' state, proposed an amendment to the financial regulation bill that just passed that would have capped the number of payday loans at 6. I thought that was really interesting. It took the payday lenders at their rhetoric, that these are emergency loans, and if you're doing more than 6 of these loans a year, that's no longer an emergency. That's just a really, really expensive way of balancing your checkbook. Senator Richard Shelby blocked it. It never got anywhere. But I don't know if we should outlaw tomorrow the payday loan, because I think what that's going to mean is really good news for the banks, because their bounce check fees are going to go up and their credit card late fees are going to go up. It's not as simple as doing one thing. So I'm really intrigued by ways that get at the problem. What Alejandra mentioned, 2-week loans, like, I'm just repeating a thing I just said, but if you're got to pay all that money, a $45 fee on a $300 loan, what are the odds in 2 weeks that on top of your regular bills, you're going to have an extra $345 laying around when you get $1,200 take home a month? So the duration, let's come up with a usable product. Okay, they're going to be expensive. You got lousy credit. They're not secured. There's just a promise that you're going to pay it back. But let's come up with a product that gives people a fighting chance of paying it back. In North Carolina, the State Employees Union, I'll finish up, they have a payday loan product. I mean, you have to be a state employee or a teacher to be part of this credit union. But they have a payday loan that they charge a 12% annual percentage rate, and the guy who runs it, Jim Blaine, says it's his single most profitable product. It's a not-for-profit, but they make money on these payday loans. But what I think is brilliant about the way he set it up is as you're paying back the payday loan, a little bit of it is going into a savings account. So on the other side of the payday loan, not only have you paid it back at a more than reasonable rate, 12% is very cheap, but you also have a savings account, so you don't have to take out one of these and ever pay 12% again, and maybe you could get your 2% or 1% or whatever savings account interest rate you're getting rather than leaking 12% or 400%.
Yeah. Actually, we have a wonderful audience here with some experts and even some authors of some of the research that I think you cited in your book. So definitely want to open it up for some comments and questions. You can let me know if you have questions for Gary. We'll come right here first.
I understand that the people at the top are making a lot of money. What about the people in the branches who are actually pushing these? Are they making a lot of money?
Yeah, one of my favorite chapters is about this one woman, Chris Browning, who for 10 and a half years was the manager at one of these payday loan stores. I could look it up right here, but I think her starting salary was $22,000 a year, and there's a lot of bonus money. The more people you bring in, the more bonus you're going to get. But I think she could max out at $6,000 in bonus money, which is still like almost a third of their paycheck. It's quite the motive. And I think when she left, she was making about $30,000 a year. And the great irony here, whether you're talking about rent-to-own, payday lending, any of these fields, is that the very people running these stores, not just their employees, are the customers that they're dealing with. They're all $30,000 a year or less.
Yeah, in the front here.
So two questions. You mentioned in your book that I think the United States is second only to Japan in terms of consumer lending, the amount of consumer lending that occurs. So I'm curious if there's ever been any comparative studies about how they deal with consumer lending problems there as opposed to the United States, or in general just more of a comparative approach to try to get some new perspectives on what we can do, go looking even outside the United States. And the second is that you mentioned in your book that Walmart's getting into, at least on the check cashing level. So I'd just like you to comment a little bit on the role of competition in helping to rein some of these practices in.
Right. So Walmart, as of 2 or 3 years ago, started introducing check cashing at their stores, and they're up to about a quarter or a third of their stores around the country offer it. They also are in the debit card business. And, at first, my reaction, maybe a bit of a knee-jerk reaction, was like, oh, my God, Walmart too. But then the more I thought about it, I thought, well, this is a good thing. I mean, the aim here, we need check cashers. There are 17 million or so unbanked people in this country, people without a checking or savings account. They get a check. They get their paycheck. How are they cashing? We could outlaw check cashers tomorrow, and you know what's going to happen? The liquor stores and the grocery stores are going to offer, and they'll charge, probably even more of a fee. It'll be more of a mess. So I thought, well, the aim here, I'm in New York, it's like 1.9% is the maximum you could charge to cash a check. If you live in Georgia, it's 5%. You live in Kansas, where Tim Thomas at Daddy's Money Pawn lives, there's no limit. He charges 10% for a handwritten check. So I thought, something, competition is good, because what it does is it drives down the price, and that should be the aim. The service is too expensive. The moral issue here isn't doing business in the inner city, a working class enclave, a rural area that's fallen on hard times. It's the amount of profits these companies are making. How comes the check cashers in New York make plenty of profit at 1.9%, and the people in Georgia are doing it at 5%? The subprime credit card companies, they have been making 2 or 3 times the profit margin on their subprime customers as on their conventional customers. There's this notion I learned about risk-based pricing. Well, I'm going to charge you more to loan you money because you have a damaged credit card and you're a greater risk. It wasn't risk-based pricing. It was opportunity pricing. They built in the risk and then a load of profit. Why did the subprime mortgage lending business become so big? Because the big banks, you name a bank, they were in subprime mortgage lending as originators. They saw the profits that subprime mortgage lenders were making, and it was 2 or 3 times the profits they were making on their conventional customers. So that, to me, is the moral issue, is the amount of profits. To your first question, a little bit out of my realm, but I do know that Japan came up with a national usury cap. I mean, how that's played out and what it means, I don't know. I just know that they, in fact, took a step that Dick Durbin, among others, is pushing for in this country.
You actually had raised a number of these policy issues here. The local terrain being so important, where that's where actually a lot of regulation is set, and it varies tremendously. And it's been hard for people to and advocates to figure out what's happening where. And the importance then of the local regulators who have oversight over these markets need to be empowered to be able to act and when they want to take on a little more aggressive stance than some of the federal regulators, they need to be able to do so. They're often on the front lines when seeing these practices emerge, and they do vary tremendously. I'd definitely much rather cash a check in New York than in Georgia. Yeah, right here. Yes, you do. You do need a mic.
We're recording.
If you were chosen tomorrow to head the Consumer Financial Protection Bureau, and you had to choose between all of these lending practices, what would your priorities be?
Payday lending. Payday lending is just so large. I mean, we're talking about so much money. You're not getting a tangible product. I mean, check cashing, well, okay. You don't have a bank account. There is a risk involved. Rent to own, really expensive. The brilliance of the rent to own business is very simple. They have figured out that instead of selling a TV for $500 like Best Buy does, if you rent it by the week, you could get $1,200 for that TV. But at least on the other end, you got your TV. It's a very expensive way to get it. Payday lending is just so big and so destructive to people's finances. One statistic to complement what Alejandro was saying, there's 4 states in this country that monitor payday loan usage, and they all have more or less the same finding. 1 in 5 customers has a payday loan for 21 or more payday loans per year. That means essentially for the entire year you owe the same $500. There's 10 million or more people who use these things. That means 2 million people a year are paying, not in effect 400% interest for a loan. They are paying 400% interest on a loan. On a $500 loan, that's an extra $2,000 in fees. We're talking about people $20,000, $30,000, $42,000 if you want to go up to your $50,000 number, paying those kind of numbers.
Yeah, and if the Bureau is really designed to shut down predatory practices in the delivery of financial services and products, how much of the payday sector can survive? I mean, given their business model, does it work in the new framework? I mean, I'm having a hard time seeing how it does. So I think that it certainly should be one of the main points on their agenda rolling out of the gate here. Chester and then David.
Chester Hartman from PRAC, the Poverty and Race Research Action Council, where we had the good fortune to have Alejandra as a Congressional Hunger Fellow many years ago. Gary,
now we've got her whole biography out in the open.
Gary, as you're likely aware, the cities of Baltimore and Memphis have brought suit against Wells Fargo for discriminatory lending, and they're represented by one of the really good civil rights firms, Rivlin and Dane.
Sure. If
If that suit prevails, which I would predict is going to be the case, what are the implications for other cities and other lending institutions for the whole problem you're talking about?
So the suit against Wells Fargo was filed first, and it's pretty much been thrown out. The way I understand it, the judge threw out most of it, and the active suit that people are paying attention to is Memphis. Essentially the argument, to sum it up for those who don't know, is that the African-American community in Baltimore, Memphis, around the country was making progress with home ownership. There were great efforts like self-help, where Alejandra worked to get people into homes, and what happened with the subprime mortgage crisis is so many people refinance homes they already own. They were convinced to take home equity loans that just had these awful terms, and what's happened is a generation's worth of progress has been wiped out like that. All this progress. I mean, Martin Eakes, I love an expression he uses, a bricks and mortar savings account. What's wealth in America? Most of it is home ownership. What's wealth in America among the middle class? It's home ownership. And so much progress was made, and predators like Wells Fargo. Wells Fargo, a couple of people who worked for them, lenders who worked for them, turned state's evidence, whatever the right term is. They've testified against the company, talking about their practices and how they specifically targeted the black community. There was a congressional hearing years back where they asked somebody, a former lender, who are you looking for when you're looking for potential customers? Someone of color, an older woman, living on her own, owns equity in her home, maybe owns her home outright, living on fixed income, Social Security, pension from her dead husband, that was his term, who has some credit card debt, because they knew they were vulnerable and they could just be predators. That's what Wells Fargo did. That's what a whole long list of well-known brand name banks have done. What are the implications? Part of me thinks that subprime mortgage lending is more or less dead forever, and it's whack-a-mole, and there's going to be some other product that we don't see, and the Consumer Financial Protection Bureau hopefully will see but might not see, that's going to come down. So I feel like this is one of these cases where there will be some justice for people in Memphis, and if they are victorious there, maybe there'll be more suits. But as far as policy prescriptions, I feel like the subprime mortgage has been so publicly destroyed reputation-wise that that's fighting the last era's battle.
And it's also gone away. I mean, the subprime mortgages are not
right. Temporarily gone away. I mean, they could come back.
Mm-hmm.
They could come back.
Yeah. Let's get some more questions here. David?
According to the FDIC, the largest component of the fringe economy is actually buy here, pay here auto lots. And my question is, if auto lending is excluded from the Consumer Finance Protection Bureau, although it might be regulated elsewhere, but given the adaptability of Poverty Incorporated, is it conceivable that this sector would eventually morph into something even or equally as Machiavellian as what you've written in your book?
Right. So one of the great challenges in writing about this topic that I didn't appreciate until I was into the research for this book is there are so many ways that entrepreneurs, big corporations have figured out how to get rich off the working poor that I couldn't cover them all. So I actually give very short shrift to auto lending, subprime auto lending, because I was paying attention to payday, check cashing, pawn, debit cards. There's a whole range of businesses. One thing to clarify, though, is the auto dealers won an exemption from the Consumer Financial Protection Bureau, not the buy here, pay here auto sellers. So they, in fact, do fall under the Consumer Financial Protection Bureau. In fact, maybe I'll revisit my answer to your question. Maybe I'll put them first, because the thing about a subprime mortgage is instead of 6%, people were paying 9%, 10% in the 2000s, so it was a 50% premium. I'm a Manhattanite. I don't own a car, but what is a car loan nowadays? 6%, 7%, somewhere around there. If you're a subprime auto borrower, you're going to pay, depending on the state, 18%, 20%, as high as 25%. There's a few states that there's no cap, and they're charging more than 25%. So we're talking about 3x, 4x, that the subprime borrower is paying like 3 or 4 times the rate as the conventional borrower. I really do want to revisit my answer. We're going to take the auto, I'm in charge, we're going to take on the buy here, pay here first, and then we're going to get to the payday lenders.
One of the points I've been making in this debate over financial reform is actually the language in the bill which got through was establishing a new set of principles which would govern the financial services marketplace. And in the past, it was really about disclosure requirements. You'd get safe haven if you told the customer the product terms and conditions. And of course, it was written in legalese, and nobody read the material, and they didn't understand it. And if you ever bought a house, you just sign your name, no matter who you are, without reading any of the material over and over. But we've shifted now. We have a principle-based regime, but we don't know what it's going to mean. And I feel like if we establish a little bit of meaning to what some of these principles of transparency and fairness are, we'll set some new standards going forward. That's going to take some time, and in the meantime, I don't see the alternative to the whack-a-mole regulatory scheme. It just has to be an active game. I mean, the regulators have to play. They've got to whack the mole, and they've got to come to work every day figuring out that our job is to find the new mole and to be empowered to shut it down. And that's, I think, potentially a good thing, and to take away some of the the profit ability of these activities when they run afoul of these principles. And so maybe that we should celebrate this new game, and the fact is that we've got some mallets that hopefully can be used. Anyway, that's my analogy. So should we play whack-a-mole?
Yeah, no. I mean, I think the most persuasive way to talk about the potential power of this new bureau is to say that I monitor the payday lending, payday lending blogs. I get Checklist magazine, the magazine of the check cashing industry. I get Pawnbroker Today, and these other publications. And more interesting than you think, but or maybe I've just kind of gone down a weird hole. But anyway, they have thrown everything they have into fighting this. The payday lenders used to have 2 lobbyists here in Washington. They have a dozen. They've spent, collectively, these Poverty Inc. businesses have spent millions of dollars. They talk about this is an extra level of bureaucracy, and, they're intruding on our business. And I can't think of any greater compliment to the way the law was written than to read their rhetoric about how intrusive this is going to be into their business. Reed is right. The game here is just to stick with it and, find the ways of limiting the kinds of ways they are ripping people off, and hit at it. And when they respond by saying, 28% cap, then we'll offer $15 credit checks and application fees, then you whack at that. That is the necessary evil here.
And I'll just say that I do think that we're in such a time of transformation of the financial services marketplace. It's going to look very different in the next number of years. And so we're going to have to play this game. Here and then in the back.
Yeah, well, to address that last question, I've attended FDIC's advisory committee meeting, on the small dollar loan programs, the pilot programs, and some of the smaller banks who started it, they are afraid that bigger banks may not be able to pick up on it because it's not as profitable. So how do you address that question? How do you create competition for payday loans if it's not profitable? Like even some credit unions are charging such huge
Goodwill
rates.
charges $10 per hundred, which is an annual percentage rate of 200 plus. Percent. I guess I want some help from Alejandra here. I think this is more her area. I know of one innovative effort in California that Schwarzenegger has put together around getting the big banks and the community activists together to help bank the unbank. Yeah. And I think they've had some success, but I feel like this is
an idea we helped launch here.
Oh, great.
Bank on. But anyway, Alejandra.
So with all due respect to our dear colleagues at the FDIC, who I know are working really hard on this, just a few quick thoughts. I'm not sure that it's the same proposition for the mainstream banks that creating competition, flooding, players into this market will produce more loans for more people. I think it's a different value proposition for banks and credit unions. Is this on? I think what the small dollar loan pilot has revealed is that the participants are engaging in just good old-fashioned relationship building. I mean, they're using this extension of a loan as a way to secure a relationship with the borrower, or to think about referrals and other ways to strengthen the relationship with the customer. So it's not necessarily the the same approach that has worked in the alternative financial services sector. That said, I think that mainstream banks should take a page out of some of the payday lenders and check cashers and do what people have preferred, which is make it quick, make it easy, make it non-intimidating, and I know that they're working on new models to make it easy, perhaps through the workplace.
And that's an example of where we could see mainstream banking change, maybe for the better. At the same time, we know there's going to be innovations in technology that people are going to be using kind of these things to bank as well in the future. So that's my point about the landscape changing significantly. Yeah, in the back. I think this is a plan. No. Let's see.
Hi, Gary.
Hi, Judy.
I knew it.
I just want to make a quick plug. I think one of the missing pieces that will really feel the next few years is the role of grassroots organizations and representing poor communities and communities of color. Those of us in the room that have connections to Center for Community Change, to National People's Action, to ACORN, have been fighting very hard for these issues since the early 80s, and were called financial terrorists and really discounted. And I feel like there's a role that policy groups and think tank groups can play in helping elevate those voices of those folks. They're speaking directly for their own communities that were sort of treated before as sort of scruffy or not quite knowing what they're talking about. Yeah. When if these people had been saying 20 years ago, this is a real problem. And I think this is a real missing piece, and particularly with ACORN now, no longer in the mix in the same way. There needs some more attention to what supports community-based organizations to help advocate for their own communities.
I mean, that was another bizarre thing of researching and writing this while watching the news roll along, because I'm reading about the worst predatory subprime lending, big major corporations, household finance, going through ownership records in poor communities, figuring out who owes a lot of credit card bills, pushing their products on people, not waiting for people to come. And who is at the forefront of fighting this? And the articles, they're suing, they're protesting. It's ACORN. And I was thinking, I knew ACORN anyway, but I was thinking, wow, good for AARP, ACORN, a lot of local groups. I mean, there's amazing work.
Actually, we're doing, a lot of people are now reading the bill that's been passed. And we did an earlier version looking closely at the House bill, and we're going to be releasing a paper on what's in the Senate bill. But there's anti-ACORN language in the, I believe it's in the final version. It was
literally
in the House bill.
ACORN.
Yeah, ACORN being not able to be a recipient of some of the support. Not sure if it's in the final version or if it was in the Senate bill. But anyway, it's apropos of this point, yeah.
And to add one thing, I mean, it's in the book, but I haven't spoken about it here. The consumer advocates have been having a lot of victories. The payday lenders used to make a profit margin of 25%. I used to cover Silicon Valley for the New York Times. You'd get noticed in Silicon Valley with that kind of profit margin. And between them overbuilding and getting greedy, but also the consumer advocates fighting back, their profit margins are down to 10%. You look at the instant tax refunds. They used to charge, the equivalent interest rates of 100, 200%, sometimes more, but at the National Consumer Law Center, you had Chi-Chi Wu, you had Jean Ann Fox at the Consumers Federation of America. Did I say that right? Yeah. Fighting and successfully pressuring these groups to these banks, these lenders, to lower their rates. And in fact, J.P. Morgan Chase just announced, we don't need the bad publicity anymore. We're out of the instant tax refund business. So the consumer advocates have had some really significant victories. They might not have ultimately been victorious, but they've had a big impact.
Final question here. Yeah.
You've spoken a little bit about some of the rent-to-own businesses. Would you describe them as predatory as the payday lenders and other such things that you've discussed, or is there some good role for them?
One of the weird things in doing this project is, there is almost a hierarchy. In fact, let me quote somebody else. Roy Barnes, the former governor of Georgia, has a really good guy, has been fighting for decades predatory lending. And, he said earlier in his career, he's a lawyer, champion. He actually owns a bank, but he's a more responsible lender. He said early in his career he used to take on rent to own. He used to take on those who were making loans, ECADs, at annual percentage rates of 60%. Nowadays, those are the good guys. You know, when you're talking about auto title loans, we haven't spoken about it here, they have collateral. They have the title to your car. I mean, that is worth a lot more than the $500 they're loaning you, but they're still charging 300% interest in some communities. So suddenly, those who had been the devil in the past, they're not even on the hierarchy anymore. I did a media appearance last night that prompted a pawnbroker to send me a note, send me an email, saying that, you know, hey, you're being mean to us. You know, it's like, and you know, he's right. I mean, the truth is, you don't fall into a trap with a pawnbroker. You bring in the ring, and they say, you know, they could sell this for $200, so they're probably going to give me $75 for it. And I'll try to pay back the $75 they loaned me, and if I can't pay it back, I lose the ring. I don't fall into a trap. I'm not every 2 weeks having to pay this, you know, god-awful huge fee while I still owe the money. It's not a trap. So, you know, the pawnbrokers, the Roy Barneses of the world 20 or 30 years ago used to fight them because they're charging annual interest rates of 60 to 300%. Nowadays, they don't even really make the radar screen of the advocates.
All right, so a new set of standards so we can discern a little bit better. All right, thank you, Gary, for coming. Broke USA. And Alejandro, thank you. Thank you for coming. Appreciate it.